You say the structure of the public markets makes it no longer attractive to buy stock in small cap companies and publish research on small cap companies. But can this really save the middle class? As you say, boil down your thesis for us.
Yeah, there's really two things going on here. The big picture is the number of IPOs, particularly for small cap IPOs, has gone down to about 1/5 the level that it used to be about 10 years ago. And what our concern is, there's really two fundamental issues that creates. Number one is job creation. So small cap companies in particular actually accelerate their hiring after they go public. So in a world where you see something like 88,000 new jobs created last month, we think we can actually accelerate job creation significantly here. And number two is it just leaves a whole segment of the market out of the ability to appreciate the kind of growth in these stocks. Namely, those are public market investors who don't have the ability to invest in private equity funds, venture capital funds, or other vehicles that actually can invest in these companies while they're still private.
So let's take a step back and look at the facts. Less companies are going public. Companies are waiting longer to go public. And when they finally do go public, they're going public at a higher valuation, so the public can't benefit as much from the wealth creation. You point out Microsoft versus Facebook as an example. Using those two companies, why is it so dangerous to wait?
Yeah, so if you look at the Microsoft case, so Microsoft went public at about a $500 million valuation. And if you look at what's happened since then, the company has gone up roughly about 500 times as a public company. So if you were a public shareholder and had bought Microsoft, you would have been able to benefit from that appreciation in the stock. If you look at Facebook, Facebook went public at $100 billion. And just to kind of compare those results, if Facebook were able to have that same appreciation, that 500 times appreciation, it would have to have a market cap of roughly $50 trillion, which is basically kind of the sum of all the listed equity markets today. So what's happening is more of the appreciation is being seen by people who are investors in the private market, and less of that appreciation is available to public company investors.
So part of the problem, you say, is decimalization, by which companies can only now be traded in increments of a penny versus increments of 25 cents. Another problem you point out is the fact that it's no longer profitable to publish research on smaller IPOs. However, a lot of these rules were put in place to protect the public rather than to help them. How do you respond to that?
Yeah, so I'm not saying by any means that everybody should invest in every IPO. That's a decision that people should make based upon the fundamentals of the company. But what we do think is people should have that opportunity to evaluate it. And as you said, the problem is what's happened is you've taken all of the profits out of trading small cap stocks. And it turns out that a lot of those profits were actually used to subsidize investment research for firms. And so it's kind of a double whammy that we've seen here, which is reducing the profits on trading, which means we can no longer subsidize research. Therefore, these stocks are a lot less liquid. And now we have a problem with companies delaying IPOs because of the hostility of the public market for those small cap companies.
So what should the SEC do, in your opinion?
Well, so the SEC has actually the ability under the Jobs Act, which was passed last year, to solve this problem. So Congress basically said to them, look, you should study the effects of decimalization. And if you conclude that it has had a problem on the small cap IPO market, the SEC is empowered to either put in place a pilot program or to make a permanent change to reduce from penny tick sizes up to 5 cents, 10 cents, 25 cents, whatever the experts at the SEC determine they should do. And certainly our view is we think any change that the SEC does here could have a very material impact on the trading of these stocks and therefore would help actually jumpstart the IPO process for small cap companies.
So the counterpoint would be, are you pining for the good old days of the IPO frenzy in the 1990s? I mean, that worked out really well for everyone.
Yeah, no, as I said before, nobody should invest in IPOs other than to the extent they understand the financial risk. So that's not the issue. The issue here is, number one, is job creation. Could we basically create an accelerant to job creation through IPOs? And, we all agree that IPOs are actually a job accelerant. And number two is, should we really cut out 96% of the Americans, which is basically all the people who are not accredited investors and therefore don't have access to these companies in the private stage? Should we basically cut them out from the opportunity, at least, to evaluate the growth prospects that IPOs often bring?
The other critics would say it's not surprising that a venture capitalist wants more exit options for portfolio companies. How do you counter that accusation of self-interest?
Yeah, the venture capitalists are going to be fined here regardless of what happens with the IPO market. And we're already seeing this in the venture capital world, which is the benefit to us and to our investors is because time to an IPO is a lot longer, there are many more points along a company's life cycle that we can invest and therefore gain the appreciation of the stock along those levels. So this is not actually something that I think is critical to the long-term success of the venture capital business, but I think can actually help create, as we mentioned, both jobs as well as kind of broaden the market to a broader class of investors.
Now, taking the argument just one step further, some of the changes that you talk about also led to a consolidation of the underwriting business. However, that has subsequently been reinforced by the fact that Andreessen Horowitz and other venture capital firms are giving their best deals to the big banks like Goldman Sachs and Morgan Stanley. Should venture capitalists give more deals to the smaller banks and help the littler guys?
Yeah, I think there's no question that to the extent that there are people who will actually provide broad-based research coverage for these companies, that it's important for the companies and the boards of those companies when they're going public to include a broad cross-section of firms. So I think that's absolutely something that we should be doing. And again, the key question to me is, will those companies provide research coverage? And if that happens and that helps the liquidity of these stocks, that's a win-win for everybody involved.